Inflation in the US recently came in at 3.4%, sticking around that 3% range that it's been hovering around since June of 2023. That is still substantially above the Federal Reserve's 2% target. Despite this, the stock market rallied quite substantially following this inflation print, leaving many people confused. The market seems irrational today, taking even bad economic data points and moving higher following them. It feels like investors are finding any excuse to FOMO and buy into this market to really avoid missing another move higher. Now, the first thing that I want to say regarding this is don't fight this market. We've been doing this for a while and we've made many mistakes when it comes to the markets. In fact, fighting any trend is something we would caution against. Use tools to identify the trend and take advantage of it. Today, that trend is up, whichever way you look at it. Yesterday, we did send out a warning to our members that we could see a short-term correction in stocks over the next few days. We cut out some of our stock market trades to protect ourselves from this, but the big question is whether this broad uptrend that we have had on the market is going to continue. If so, we should see any correction in stocks as an opportunity to add back exposure to the market. If you think about the two reasons why the market is moving higher today, it's a combination of stable interest rates and rising profits. And if we can figure out how long this environment can last, we know how much the market can rally. Let's first take a look at stable interest rates. The Federal Reserve is ultimately the most powerful institution in the world, and they set the level of interest rates with the federal funds rate. They raised interest rates throughout 2022, but they stopped raising interest rates in June of 2023, and they've kept them stable ever since, even talking about reducing interest rates sometime in 2024. And ever since they've been talking about that, the stock market has been exploding higher. Now, this is where many people are angry with the Fed because they see that inflation is still at around 3%, which is above the Federal Reserve's target, and they believe that the Federal Reserve should actually be raising interest rates in order to continue seeing inflation head lower, definitely not thinking about lowering interest rates, which could stimulate the economy and lead to inflation moving higher again. Now, I'm going to tell you why this is completely ridiculous and based on wrong assumptions. First, we can see many moments in history where inflation actually hovered around or above 3%, like in the late 1990s or a couple of times in the 1980s. And when we look at what the Federal Reserve was doing in these instances, they were cutting interest rates. So you can see we can absolutely see the Federal Reserve cut interest rates and still see inflation drift down lower just like it did in the 1990s. What the Fed actually pays attention to is that interest rates are higher than the level of inflation. And you can see that was definitely the case in the 1980s, and that was also the case in the 1990s. When they don't do that, for example, here in 1975, interest rates were lower than the inflation rate. That's something called negative real interest rates, and you have elevated risks of seeing inflation pick back up again, which is exactly what we saw in the 1970s. Today, that's not the case. Interest rates are higher than the rate of inflation. In fact, that's been the case since June of 2023, the exact moment when they stopped raising interest rates and started to keep them at a stable level. I can also show you why inflation isn't really at 3% right now and is probably going to be shifting lower. You see, 30% of the CPI is shelter. So that's basically the price of rent. That's the largest component in the inflation data. And when we look at the shelter CPI, it's currently at 5.5%. So this is actually pulling the rest of the inflation number higher. The problem with this is that the shelter CPI is actually lagging relative to what actual housing rents are doing. The shelter CPI takes into account ongoing rents, which are often 2 to 3 year contracts, as opposed to just looking at the prices of new contracts, which really reflect what rents are doing today. When we look at an index called the New Tenants Index that just takes into account new housing rent prices, well, it's actually showing us that rents have been declining in price for the first time since 2009. Now, don't get me wrong, housing did get a lot more expensive throughout 2022 and 2023, but the most recent data suggests that there is a plunge in housing inflation, which means that the shelter CPI that's currently at 5.5%, making inflation as a whole higher, is actually going to continue moving lower. Now, I know you guys are going to say that the inflation data is completely twisted and false, and we shouldn't trust it. And you might be right. That might be the case. I don't know. But the Fed trusts this data. And the Fed's perspective is the only important perspective. And what they're seeing right now is 3% inflation that's likely to continue drifting lower, not higher in the coming months. And so in our opinion, they are right to think about interest rate cuts today. And yes, all things being equal, if they do that, that would be a good thing for the market. Okay, great. So we know that interest rates are stable and in our opinion, they're likely to remain stable. But what about corporate profits? Because that's the second key reason for why the stock market has been moving higher. You look at S&P 500 earnings and they've been climbing higher steadily over the last couple of years. Can that actually reasonably continue? Well, you guys know our opinion on this. This growth isn't going to last forever. In fact, there's a pretty substantial risk that we see corporate profits decline violently as a result of a recession over the next year. The yield curve has been inverted for one of the longest stretches in history, only comparable to 2008, 1929, and 1974. Three of the most severe recessions in recent financial history. There's also a direct correlation between the number of days where the yield curve has been inverted and the size of the market correction that occurs during the recession that follows. Today, it's been around 600 days since the yield curve initially inverted, which does predict a substantial decline in the stock market in the next recession. If we're right about the fact that 600 days of inversion is going to lead to a substantial correction in the stock market, this could lead to as much as a 50-60% drop in US stocks in the next downturn, which would likely mean that corporate profits decline quite substantially. But is that going to happen today? Is that going to happen in a month or 6 months? Maybe even a year? That's why currently we're not fighting the trend on the S&P 500. We just had a McClellan breadth thrust that we discussed in a recent video, which predicts with a pretty high degree of accuracy that the stock market can move higher over the course of the next 3 months. Our goal at the end of the day is to make sure that you guys are on the right side of the trade, benefiting from all types of market environments as much as possible. We go through our entire trading strategy in a lot more detail on our website, all of the best trades that I see at any given moment, and along the way I teach you basically everything I know about how to make successful trades. Thank you for watching.